if you're a young person and you get into investing, make sure you get into investing for the right reason. Because a lot of people get into investing because of the payday. Yes, this job potentially could pay a lot of money. However, if that's the only reason you get into investing, you're going to be miserable. Because you'll be competing against people who love that, who will be doing this not because of money, but because they wake up in the morning and they can't wait to read another annual report or to listen to another conference call. So number one, make sure you actually love it. So don't get it for money. Number two, don't focus on building a large portfolio. Take as much money as you can afford to lose and invest just in a very few companies. So you're not focusing on building kind of diversified portfolio. What you're trying to do at this point is focusing on analyzing companies and go as deep as you can. Now, the question comes, what company should you start with? Okay, and this brings me to the third point. Now, we all have different backgrounds. If you work in the restaurant industry, you can start with restaurants. If you have a background in aerospace, start focusing on aerospace companies. Because what happens in investing, when you analyze companies, you're analyzing the business. What you're trying to do, you're trying to build the world. If you know already how the supply chain of aerospace companies, okay, the product cycle, when you're doing financial research, it's going to be so much easier for you to analyze it because you actually can relate to the product. You actually understand the business. If you work for a restaurant, then you actually understand things that matter in a restaurant. Okay, your background can be very, very important. Now, if you never had a job at a restaurant before or aerospace, okay, and maybe you never had a job before, period, you probably have some hobbies. You may know a lot more about Formula One racing than others, or know about sports or gaming industry, whatever your hobbies were. Try to find companies that you touched through your hobbies at least. Point number 4, I think it's very important to find kind of your investment heroes, but it's also very important to understand how they think, not what they think. Okay, because let me give you an example. When I started investing, I was told that Warren Buffett does not use computer, does not use Excel spreadsheets. So I thought, well, Warren Buffett doesn't use Excel spreadsheets, I won't use Excel spreadsheets. Well, the problem is Warren Buffett has been doing it for a long period of time. He started investing before computers. Okay, he can do math in his head so much better than I can. I'm not Warren Buffett, so I need spreadsheets. Okay, I need them desperately. So at the same time, there's many other things I learned about from Warren Buffett. I learned about margin of safety, about long-term time horizon, about the tenets of value investing. But I realized that I have to become the best version of me. Okay, and it's almost like when you buy shoes, okay, they have to fit you. Okay, when you buy a jacket, it has to fit you. Okay, so does your investment strategy. It has to fit your personality. Another anecdote there is that Warren Buffett famously said, I don't buy technology companies because I don't understand them. That kind of makes sense because for a big chunk of his career, technology companies were not very important to the US economy. So a lot of value investors, they basically said, a lot of value investors who were 25 years old, they said, I don't buy technology companies because I don't understand them. Well, what they just did, they just parroted, Warren Buffett. The punchline of the story is Warren Buffett's biggest investment and one of the most successful investments in dollar terms was a technology company, Apple. Okay, so Warren Buffett realized that as the U.S. economy changing, he needs to change as well. He expanded his circle of competence and understood Apple. Here's a very important nuance. So what people should have learned from Warren Buffett, what he said, I don't buy technology companies, is that I have a circle of competence. Okay, businesses I understand. And I don't want a large portion of my portfolio to be outside of the circle of competence because I don't understand those companies and I'll be making mistakes. That's what people should learn from this. Okay, so the lesson still stands. You need to figure out what your circle of competence is. However, you always need to try to expand it a little bit at a time. Okay, because the world is changing and you need to be able to kind of evolve and change with the world as well. Otherwise, you will be analyzing, companies that make buggy books, for the rest of your life.